Welcome back for another deep dive. Today we're headed to India, and this time it's all about investment opportunities. We've got this document about the Nippon India Equity Opportunities AIF Scheme 9. And it's fascinating stuff. They're all about finding these undiscovered companies the kind that could become the next big thing globally.
Yeah, it's like finding hidden gems in a massive marketplace. It's specifically targeting smaller companies, what investors usually call small caps, companies with the potential to really skyrocket in value.
So we're not talking about big companies that everyone already knows, right?
Mhm.
We're talking about the up-and-comers,
Yeah,
ones with a chance to take off.
exactly. The document even highlights a really interesting statistic. Over the last decade, over 64% of small cap companies in India, those with a listing history of 10 years or more, grew more than 5 times their initial value. So that's the kind of potential we're looking at here.
Wow, 5 times your investment in just 10 years. I'm definitely intrigued. Tell me more.
Well, the interesting thing about this scheme is their must-five framework. It's not just about picking small companies randomly. They're laser focused on quality.
A must-five framework.
Oh,
Okay. So what are they looking for? What makes a company stand out to them?
well, first off, growth opportunity. The companies need to have the potential for serious growth. Like, think about a company like Infosys. You know, it started small, but it grew to become a global IT giant. That's the kind of trajectory we're talking about.
So it's not just about growth. It's about the potential for huge growth.
Yeah.
What else are they looking at?
Second is sustainable competitive advantage. What makes this particular company stand out from all the others? You know, do they have some unique technology, a strong brand, anything that gives them a real edge over the competition and ensures they'll stay ahead? A great example of this is Eicher Motors. They took Royal Enfield motorcycles and transformed them from a struggling brand into this global icon. That's a powerful competitive advantage.
So they're not just looking for companies that grow fast, but companies that can maintain that growth because they're doing something unique. Okay, that makes sense. What's the third thing on their list?
Number three is business potential. Is this company operating in an industry with a bright future? A good example is India's renewable energy sector. It's booming right now. Any company that's well positioned in that sector has incredible potential.
Makes sense. Riding the wave of these larger economic trends. Okay, what's number four?
Number four is all about capital allocation. This is about how effectively the company uses its resources to generate returns. Are they making smart investments in research and development? Are they expanding strategically?
Mhm.
You know, a company might have a fantastic product, but if they don't use their money wisely, it won't matter.
So they're looking for companies that are financially savvy, companies that make smart choices that will pay off in the long run. All right, what's the fifth and final thing on their list? What's that fifth element?
The fifth element is earnings track record. Have they consistently delivered strong financial performance? Are their profits and revenues steadily growing? It's about looking past the hype and focusing on companies with a proven history of success.
So not just betting on promises, but looking for companies that have actually delivered results. Makes sense.
Hmm.
But it's not all about the numbers, is it? What about things like ethics and sustainability? Are they factoring those things in?
Absolutely. They put a strong emphasis on corporate governance and ESG, environmental, social, and governance factors when making their investment decisions.
So they're not just looking for companies that are profitable, but companies that are doing business in a responsible way, ones that are doing good while they're doing well.
Exactly. They consider things like transparency, how they treat minority shareholders, their track record on environmental issues, employee well-being, diversity and inclusion. It's really about investing in companies that are creating value in a holistic and sustainable way.
That's great. So they've got this really robust framework for choosing companies. But what about the bigger picture? What specific areas of the Indian economy are they most excited about?
Well, this document outlines some really interesting areas with massive growth potential. It's pretty exciting stuff, actually.
Okay, this is where it gets interesting. Tell me more.
Well, one of the key areas they highlight is leading global digital transformation. So think things like IT services, fintech, all those online platforms. India's is already a major global player in those areas, but they see even more explosive growth on the horizon.
Tapping into India's tech talent. Smart. Yeah. What else are they looking at?
Another focus is on energy independence and infrastructure creation, which makes a lot of sense given how quickly India is developing. They're interested in companies involved in capital goods, roads and railways, renewable energy, and power generation. Basically, all the things that build the backbone of a modern economy.
Yeah, that's a huge undertaking. What other trends are catching their eye?
They're also paying close attention to the resilient Indian consumer. This covers areas like malls and retail, real estate, discretionary spending, automobiles, and health and wellness. India has this massive and growing middle class with increasing purchasing power. So it makes a lot of sense to look at the companies catering to that rising consumer demand.
It does. So what other sectors are they excited about?
Well, they're also interested in something they call the anti-fragile banking and financial system, which includes banks, insurance companies, asset management firms, and other financial institutions. India's financial sector has shown impressive resilience in recent years, and they see it as poised for continued growth.
Yeah, a strong financial sector is essential for overall economic growth.
Yep.
So they're looking at the companies that are providing the fuel, so to speak. What else caught your eye?
One more area really stood out to me. They call it shifting of global supply chains. They're focusing on companies that stand to benefit from the trend of moving manufacturing away from China. This includes sectors like mobile phones, electronics, pharmaceuticals, chemicals, even defense.
Wow. It's incredible to see such a diverse range of opportunities. It really paints a picture of a dynamic and evolving economy.
It does. And to give you a sense of some of the specific companies they're looking at, let's take a quick glance at some of their key holdings.
Okay, let's get into some real-world examples here.
As of November 30th, 2024, their portfolio includes companies like Affle India, Puramal Pharma, Bayer Crop Science, Max Estates, and Exide Industries. They also hold companies like Central Depository Services, India, Mastec, Proj Industries, KFin Technologies, and RD Pharma Labs.
So they've got a mix of everything from tech to pharma to real estate to industrials. It really reflects the breadth of the Indian economy, doesn't it?
It does, and these are just a few examples. Their full portfolio includes many more companies, each chosen based on that must-five framework we talked about.
Well, this is definitely giving me a much clearer picture of their strategy. So let's talk details for potential investors. What are the key things they need to know about this scheme?
Sure. Well, the minimum investment is 1 crore, which is a significant amount. So this is really geared towards high net worth individuals and institutional investors.
Yeah, not for the casual investor then. What about the overall size of the fund? How big is it?
It's capped at 750 crores with a potential green shoe option that could bring the total to 1,000 crores. The fund's tenure is 84 months, which is about 7 years. But investors do have an option to redeem their investments after a certain period.
This is a long-term play for sure. Anything else investors should know upfront?
Yes, the commitment period. That's the time frame investors have to commit their capital. That's up to 18 months, with a possible extension of up to 6 months.
So investors need to be prepared to have their capital tied up for a potentially significant amount of time. This really sounds like it's for investors who are in it for the long haul, investors who believe in the long-term growth story of India and these undiscovered companies.
Yeah.
Well, I'm already thinking about the big picture here. You know, with so much potential simmering beneath the surface, what might the Indian economy look like in, say, 10 or 20 years? How could these undiscovered companies shape the future of the country? Maybe even the global landscape?
That's a great question. It's definitely worth pondering. Imagine a future where India is a global leader in technology, renewable energy, manufacturing,
A future where Indian companies are household names all over the world.
and where today's undiscovered companies are tomorrow's giants.
It's a future that's both exciting and inspiring. But let's be realistic for a moment. Investing in the stock market, especially in small-cap companies, always has its risks.
Of course, it's important to do your research, understand the risks involved, and maybe talk to a financial advisor before making any investment decisions.
This has been incredibly insightful. I'm so curious to learn more about the implications of all of this. What else did you find interesting about the investment philosophy behind this scheme?
Well, one thing that really caught my eye was, their focus on what they call under-owned and under-researched ideas with outsized return potential.
Under-owned and under-researched. Okay, so break that down for me. What does that actually mean, like, in practice?
Well, it means they're not just following the crowd. They're looking for these hidden gems that haven't really been discovered by the mainstream market yet. Companies that are undervalued because they're not well known or maybe not fully understood.
So they're like those antique collectors who can spot a rare treasure that everyone else just overlooks.
Yeah, that's a great analogy. It takes a deep understanding of the market, a keen eye for potential, and the willingness to really dig a little deeper. And that's where their expertise comes in. They have a whole team of analysts who specialize in finding these under-the-radar opportunities.
And the payoff could be huge if they're right.
Absolutely. The possibility of those outsized returns is much higher with these less researched companies. But of course, with higher potential reward often comes higher risk.
So not for the faint of heart, then.
Exactly. This type of investing requires a certain level of risk tolerance and a long-term perspective. They're not looking for those quick flips. They're betting on the long-term success of these companies.
The document also mentions something about limited portfolio overlap with traditional pools. What does that mean for investors?
Oh, that's another key element of their strategy. This scheme is designed to give investors exposure to a unique set of companies they wouldn't typically find in those traditional investment funds. It's like adding an extra layer of diversification to your portfolio.
So if one part of the market isn't performing well, this investment might act as a buffer.
Yeah.
Because it's focused on a different segment.
Exactly. It's all about spreading your bets and not putting all your eggs in one basket, as they say.
And they're achieving that by focusing on these undiscovered companies.
That's right. These companies are often operating in these niche markets, emerging sectors that aren't well represented in those traditional funds. It's a way to tap into new and exciting areas of growth and potentially achieve those higher returns.
Okay, so the strategy is definitely intriguing. But let's get down to brass tacks here. We talked about that minimum investment of 1 crore, which clearly targets a specific type of investor.
Yeah, this scheme is really for those high net worth individuals and those institutional investors.
What about the rest of us? Those of us who don't have a core just lying around. Are there other ways to get in on India's growth story?
Oh, absolutely. There are mutual funds, exchange-traded funds, ETFs, all sorts of other investment vehicles that are more accessible to retail investors. Many of them offer exposure to the Indian market, so you can participate in that growth story without needing a huge initial investment.
Okay, good to know. Let's go back to the specific scheme for a minute, though. The tenure is 84 months. That's a pretty significant commitment. What does that mean for investors?
It means they need to be prepared to lock up their capital for the long haul. This isn't about short-term trading. It's about having that long-term investment philosophy and believing in the ability of these undiscovered companies to grow and really thrive over time.
Yeah, it makes sense that a strategy focused on these emerging companies would require a longer time horizon. They need time to develop and reach their full potential.
Exactly. And the document also mentions that commitment period of up to 18 months, possibly extending to 24 months, that's where investors gradually commit their capital.
So even though the fund has a tenure of 7 years, investors might not have access to their full investment amount for up to 2 years.
That's right. It's really important for investors to understand those timelines, make sure they have enough liquidity and are comfortable with the commitment.
All this talk about long-term potential is exciting. But let's not shy away from the risks here. The document highlights those inherent risks of investing in small-cap companies. Why is that?
Well, small cap companies are generally more volatile than those larger, more established companies. Their share prices can fluctuate a lot more dramatically.
So they're kind of more susceptible to market swings and economic downturns?
Exactly. They may also not have the same financial resources as larger companies to kind of weather those storms, and they might face challenges like access to capital competition from those bigger players, or maybe even a lack of experienced management.
So potential investors need to really weigh those risks against the potential rewards.
Oh, absolutely. They need a realistic understanding of both sides of the coin.
What about the risks associated with investing in pre-IPO companies? The document mentioned those as well.
That's another important thing to consider. Pre-IPO companies are companies that are planning to go public, but haven't done so yet, meaning their shares aren't traded on a stock exchange.
So investors can't easily buy or sell those shares. What are some of the risks associated with that?
One is a lack of transparency. Pre-IPO companies aren't subject to the same level of regulatory scrutiny as those publicly traded companies, so there's just less information available to investors.
Which makes it harder to really assess the company's financial health and the potential risks involved.
Exactly. And there's also the risk that the IPO might never actually happen. The company might postpone it or cancel it for any number of reasons, like unfavorable market conditions, inability to raise capital, regulatory hurdles.
So investors could be left holding shares they can't sell.
Yeah, that's a possibility. And even if the IPO does happen, there's no guarantee that the share price will do well. It's a high risk, high reward kind of proposition.
Okay, so pre-IPO investing is definitely not for the casual investor.
Yeah.
What about the overall risk profile of this scheme? The document classified it as a Category 3 alternative investment fund.
Right. Category 3 AIFs are typically higher risk funds that are open to a limited number of sophisticated investors. They aren't subject to the same level of regulation as mutual funds or other retail investment products.
So while that gives them more flexibility to invest in a wider range of assets, it also means that investors need to be extra aware of the risks involved.
Precisely. They need to understand that their investment isn't protected by the same safeguards as those traditional investment products. Category 3 AIFs are generally best suited for investors with a high risk tolerance, a long-term investment horizon, and a deep understanding of those financial markets.
Makes sense. Before we move on, I'm curious about the fees and expenses associated with this scheme. Is there anything investors should be aware of?
Well, the document doesn't provide specific details on those fees and expenses, but it does direct investors to the private placement memorandum for more information.
So it's crucial for any potential investors to carefully review that document to understand that fee structure, any expense ratios, and any other costs involved.
Absolutely. Those fees and expenses can eat into your returns, so it's important to factor them into your overall investment strategy.
Speaking of returns, what benchmark are they using to measure the performance of this scheme? What are they comparing it to?
They're using the Nifty Small Cap 100 Index, which tracks the performance of 100 small cap companies listed on the National Stock Exchange of India.
So investors can look at how the fund is performing compared to that nifty small cap 100 to see how it stacks up.
Exactly. But it's important to remember that past performance isn't a guarantee of future results. Investing in the stock market always has its risks.
Right. It's not a crystal ball. Before we wrap up this part of our deep dive, I want to highlight a few key takeaways for our listeners.
Sure. What do you think is most important for them to remember?
Well, first and foremost, this scheme offers a really unique opportunity to invest in undiscovered companies in India, companies with the potential to become major players. But it's crucial to understand this is a high-risk, high-reward investment strategy. It's not for everyone. Investors need that high-risk tolerance, a long-term investment horizon, and a solid understanding of the markets.
I agree. And they need to carefully review that private placement memorandum to understand those fees, expenses, and risks associated with the fund. It's always a good idea to talk to a financial advisor before making any big investment decisions.
I think we've covered a lot of ground already. We've explored the investment philosophy, the potential risks and rewards, and we've even touched on some alternative ways to participate in India's growth story.
It's been a great discussion so far. What else about this scheme has you thinking?
One thing that really stood out to me was that emphasis on long-term growth. One thing that really stood out to me was that emphasis on long-term growth. It's not just about chasing those quick profits. It's about something more.
Yeah, it's refreshing, isn't it? It seems like this scheme is really about identifying those companies that are building sustainable businesses, the kind that can generate value for years to come, not just a quick buck.
Exactly. And that really fits with this idea of investing in undiscovered companies, right? Because those companies are often in the early stages of their growth.
Yeah, they might not be household names yet, but they have the potential to really become major players in their industries.
That's where I see the real opportunity. Getting in early and riding that wave of growth as these companies evolve and mature.
It's like planting a seed and watching it grow into this huge tree, reaping the rewards as the tree starts to bear fruit. But it takes patience, right? And a belief in the long-term vision of the companies you're investing in.
That long-term vision, it's like it's woven into the fabric of this whole scheme.
Yeah.
What else about their approach resonated with you?
Well, I think the role of innovation is really key here. India is a hotbed of innovation, and these undiscovered companies are at the forefront of it all. They're developing new technologies, new products, disrupting these traditional industries.
Yeah, it's like this constant churn of creativity and entrepreneurship. It feels like they're not just riding the wave. It's like they're helping to create it.
Exactly. And that's what's driving the growth of the Indian economy, creating this really dynamic and exciting environment for investors who are willing to think outside the box.
We've talked a lot about the financial side of things, but I'm kind of curious about the impact of these companies on society as a whole.
Oh, that's a great point. It's not just about financial returns, right? It's about the positive impact these companies can have on people's lives.
A lot of these companies are working in sectors that are tackling those big social needs, like healthcare education, financial inclusion, renewable energy, sustainable agriculture.
Exactly. Those are all areas where innovation can make a real difference. These companies are coming up with solutions to some of the world's biggest challenges.
It's inspiring to see that kind of positive change woven into the investment strategy.
It's about investing in companies that are not just profitable, but are also making a positive contribution to the world.
A win-win for everyone. So as we wrap up this deep dive, what's the one key takeaway you want to leave our listeners with?
India's growth story, it's far from over. In fact, I think it's just getting started.
And these undiscovered companies are poised to play a major role in that next chapter. They're the seeds of innovation, the engines of growth, and the hope for a brighter future.
So keep your eyes on India, because the most exciting developments, they might be coming from companies you've never even heard of.
Well, this has been a fascinating journey. It feels like we've only scratched the surface of what's happening in India right now.
It's been a pleasure exploring this with you. I hope this deep dive has given our listeners a new perspective on investing and the power of looking beyond the obvious.
It absolutely has. Until next time, keep exploring, keep learning, and keep diving deep.